Dr. Dolly, thanks for all that you do. I was hoping to ask a question about bonds and bond allocation specifically. I know you've mentioned in the past that investors who want to reduce their risk tolerance should invest more of their portfolio in bonds. I was wondering if your opinion on this has changed at all, given the very elevated bond prices at the moment, and the potential that if an investor did want to reduce their risk tolerance by moving into bonds, they could actually lose some money if the price of those bonds go down. Appreciate your thoughts on this. Thank you.
All right. It seems like almost every question I get these days is during current times or during the pandemic or since COVID came, is this different? Well, there's very little that's actually different since that time. I mean, one thing that's different is your student loans are 0%, or at least your federal ones are at 0% until September 30th. So obviously most people are not going to want to refinance them until September 30th. But otherwise, most things have not changed. I mean, bond yields go up and down, bond values go up and down, interest rates go up and down. Unless you've got a crystal ball that is more clear than mine is, it's very difficult to take advantage of that sort of a situation. If you don't know what's going to happen in the future, you can't really anticipate it with your portfolio. I think you're much better off setting up a fixed asset allocation. You know, you set the percentages, this much in stocks, this much in bonds, this much in real estate, whatever you're going to invest in, and rebalancing back to it each year. Just because bonds had a great year this year doesn't mean you hold less of them next year. Yes, you sell down to whatever percentages are set in your fixed asset allocation. More likely, you just use your money to buy stocks. That's what I've been doing the last few months. But you don't actually change your asset allocation just because yields have fallen. And why is that? Well, if you had done that, you wouldn't have owned bonds since like 2009. You would have missed this big run-up. You know, people have been saying for more than a decade that bond rates must go up. Interest rates must go up. And what has happened? They've stayed flat or gone down over that time period. I mean, it's just really difficult to predict the future. So I don't think you should use an investing plan that requires you to be able to predict the future. I think that's a good route to really screw things up in your life. Because guess what? You're going to be wrong a lot about the future. If you don't believe that, I suggest you start keeping a notebook or a journal of your predictions about the future. And you might be surprised how poor they are, how bad you are at predicting the future. Write down specific predictions of what you think the S&P 500 is going to do, whether you think U.S. stocks are going to beat international stocks, whether you think bonds are going to do this or that, what interest rates are going to do, what the housing market's going to do. And you might be surprised when you pull that out in 6 months or 12 months, just how dumb you were 12 months ago on things that seem so obvious now. And as I have kind of done that over the years, I've realized that my crystal ball is not clear at all. And if you think yours is, either you should be running a whole lot more money than your own, or you are probably making a big mistake and leaving a lot of money on the table. But the truth is that most of us just do not have a clear crystal ball. Do you want your questions answered by the White Coat Investor? Record your question at whitecoatinvestor.com/YQA or click the link in the description.